Okay, so I'm going to talk about the advantages and disadvantages of the direct and indirect statement of cash flows. First of all, GAAP allows users to use either method they want to as of now. If users decide to use the direct method, that's essentially you're taking each cash effect for the operating activities and you're reporting those directly on the statement of cash flows. And you're going to see things like cash received from customers, cash paid out for inventory, that sort of thing. If a company decides to use this method, they're also required to provide a separate reconciliation schedule, which is essentially providing the indirect statement of cash flows. So because of this, a lot of companies just reduce the cost and go ahead and just report the indirect statement of cash flows. So the indirect method, that's you're arriving at your net income or your net cash flow number from operating activities indirectly by starting with reported net income and then working backwards to get that to a cash basis. So some of the advantages of the direct method to start with, the operating section is more intuitive and easy to understand. So unlike the indirect method when you're seeing changes in accounts and you're seeing some items that are non-cash on there, this is going to be things that are more relevant to the business, such as cash paid for goods, cash received from customers, that sort of thing. So it's easier to understand from that perspective. And also, the direct method provides users with information that you may not be able to find on the income statement or balance sheet. So you're going to be able to get things like all the cash received from customers, which is all your cash, net your receivables, and that sort of thing. So there's not a specific account for that on the income statement, but arguably it's a lot more useful to users because of that. Some disadvantages of the direct method: you have that separate reconciliation schedule, so that's going to be additional time and resources to prepare that. And also it's more difficult to prepare. A lot of company systems aren't kind of hardwired to spit out these numbers in accounts that are more useful. They kind of only run in just separate accounts, so it's gonna take systems a lot more time to go through and kind of pull out that information they need. As far as some advantages of the indirect method, it's a lot easier to prepare and a lot less costly than the direct method. Some other advantages: it provides a direct link between net income and cash flow, so you have that kind of reconciliation already there without having to have a separate table. But some disadvantages: it's arguably not as intuitive. You have changes in accounts, you have non-cash items that are on there that a user may not really understand why you're doing that or how you're ultimately coming up with your net cash flow from operating activities. It doesn't mean as much. It's not going to be your cash received from customers. It's going to be your changes in accounts. So it's not going to be as intuitive there. And then arguably it doesn't really show you any additional information. Those accounts are already on the balance sheet or already on the income statement, and it's not really giving you anything new. So that's something that's also a disadvantage.